Let's start with the topic, which is amalgamation of companies. In this topic, we'll be mainly dealing with whenever amalgamation takes place, what are the accounting requirements we have to follow and what accounting aspects will arise from different company point of view. Now, when we talk about the amalgamation, let's start with some basic understanding that amalgamation will contain three types of scenario, and all three scenarios are covered in this particular chapter. The first scenario is called as amalgamation, where two or more companies gets liquidated and they form one new company. So one new company gets incorporated where all the assets and liability of these selling companies will be shifted to purchasing company. Now, amalgamation, we normally use the term merger, or we can also use the term acquisition, where the company will dissolve and a new company gets created. So that is supposed to happen in the term amalgamation. The next thing is absorption. In this, an existing company acquires another company. So there is already an existing company, which means we are not incorporating any new company. We are already an existing company. This company will acquire other companies. So that will be called as absorption. So there is liquidation, but there is no incorporation of new company over here. An existing company is going to acquire it. The third one is external reconstruction. This is basically reconstructing your finance, and accordingly in this what happens is there is already a company, they are now undergoing a financial restructuring, and accordingly they will dissolve this old company, they will float a new company, and they will transfer all the assets and liability of this old company to the new company. So company liquidates and transfer assets and liability to a newly incorporated company. So there is a new incorporation over here, not like absorption, but here there is a new incorporation. In this incorporation, they take over all the assets and liabilities of the old company. This is over a plan of the financial restructuring. Okay, but over here, one point we need to understand is there is liquidation of company for sure. Whether a new company will incorporate or not doesn't make much difference, but the old company or the selling company is compulsorily going to dissolve in the scenario of amalgamation. Next, once we know about the amalgamation aspect, the next thing is what are the types of companies we have. So what companies will arise in the amalgamation segment? Purchasing company, the company which purchases the other company. Selling company, which sells their company to purchasing company. So if you now imagine there is company A, so there is A Limited, it acquired the assets and liabilities of B Limited. Now B Limited will get dissolved, all the assets and liabilities are acquired by A Limited. So A Limited will become purchasing company, B Limited will become selling company. So purchasing company is also called as transferee company, selling company is also called as transferor company. So accordingly, purchasing company will purchase or will take over the assets and liabilities of the selling company in return for consideration. So there is purchasing company here, there is selling company, and there is purchase consideration. All three things we need to discuss in detail now. So let's start with the accounting mechanism. First, transferee company, which is basically purchasing company. Now let's learn some basic accounting principles of this company, and with that we can apply it according to the rules and regulations applicable. First, this is the company which acquires the assets and liability. Okay, so purchasing company is the one which is acquiring the assets and liabilities of the selling company. Once they acquire, they will incorporate those assets and liabilities in the books. Maybe at the same value at which selling company produced it, we call it as book value, or it can be a different value as well. So any values are possible, and accordingly purchasing and selling company effect will come into the picture. Then this entire accounting of purchasing company will be done according to the principles laid down by AS 14. So AS 14 is the accounting standard applicable here, and in this accounting standard it tells us as to how a particular company needs to work. Finally, for doing this, the purchasing company will pay the purchase consideration. So purchasing company will be the issuer company where they will issue securities or they pay cash to the selling company. So basically, as a purchasing company, what I can imagine now, we are paying consideration in return for assets and liabilities of the selling company. So that are the two basic things which is supposed to happen when it comes to the mechanism of purchasing company accounting, which obviously will follow the rules and regulations of AS 14. Now let's talk about AS 14. Let's quickly revise the principles laid down by AS 14. Anyhow, AS 14, there is a separate AS accounting standard which we need to study in the course of our revision. But apart from that also, let's from the applicability from problems point of view, let's see how AS 14 we need to learn and apply it in our problems. So the first thing is, when it comes to AS 14, it said I will tell you how to account for purchasing company, and that AS said, or this AS 14 told us that the entire accounting will depend upon what is the nature of amalgamation. And nature are of two types. One is called as merger. The second one is called as purchase. So amalgamation in the nature of merger, amalgamation in the nature of purchase. Before we move on, amalgamation, absorption, external reconstruction, all three we consolidately call it as amalgamation itself. And apart from that, whatever we are talking from the accounting point of view, for all three the accounting will remain the same. Okay, so for that reason, if I use the term amalgamation, it is applicable for all the subtopics also what we are supposed to study. So this amalgamation will be in the nature of merger or it will be in the nature of purchase. Now we need to know what's the meaning of merger, what's the meaning of purchase. For that, AS has defined the nature of merger where all 5 conditions needs to be satisfied. Okay, so we'll learn or we'll quickly recall those 5 conditions, but all 5 conditions needs to be satisfied. The first one, all assets and liabilities of transferee company shall become assets and all assets and liabilities of transferor company shall become assets and liability of transferee company. Okay, so transferee company will acquire all the assets and liabilities of transferor company. Later, all these assets and liabilities should be taken over at book value. Okay, there is only one exception, that if at all we need to maintain uniform accounting policy, for that reason if we are making any change to the book value, then it is allowed. For example, let's assume that purchasing company is following FIFO valuation of inventory. Selling company is following weighted average valuation of inventory. Now purchasing company will acquire the stock of selling company. At that time, the selling company has valued at weighted average. The purchasing company is valuing the stock at FIFO, where both will give you different valuation. So for this reason, purchasing company revalued the stock according to their method FIFO, and then they took over stock. Now value obviously will change. Now will this lead to non-following of the conditions? No, it comes under exception. To maintain the uniform accounting policy, if they are making any variations in the valuation, then it is allowed. Next, minimum 90% equity shareholder of transferee company should become equity, minimum 90% ESH of transferor company shall become equity shareholder of transferee company. Equity shareholder, okay, not preference but equity shareholder. Fourth, the purchase consideration for above shareholder shall be paid in the form of equity shares only. What are those above shareholder? That equity shareholder of transferor should become shareholder of transferee. Then for these people, the purchase consideration should be paid in equity shares only. Okay. Now, accordingly, there is again one exception to this rule, where if fraction shares comes into the picture, it can be paid in cash. It cannot be paid in shares here. So therefore, we can pay it in cash. Let's assume that we need to pay a total consideration of 10,000 and we are paying as 30 rupee per share, which means how many shares will come into the picture? It will come as 333.33. So 0.33 you can't give it in shares. Now this can be given in the form of cash. So fraction shares is allowed to be paid in the form of cash, but rest everything should be paid in equity shares only to equity shareholder. Preference shareholder you can give it in any way. For equity shareholders it should be paid only in the form of equity shares. Next, the business which is acquired from the selling company should be continued by the purchasing company. So that will be the last condition. So let's quickly recall the 5 conditions then. First, all assets of transferor shall become transferee assets. Second, it should be taken over at book value, exception, uniform accounting policy. Third, minimum 90% ESH of selling company should become ESH of purchasing company. Fourth, the above equity shareholder should be paid, the consideration should be paid only in the form of equity shares. Fifth and the last one, the business taken over should be continued. So if all these 5 conditions are satisfied, it is nature of merger. Even if you don't satisfy any one of the condition, automatically it will become nature of purchase. So for purchase, any one of the 5 conditions not satisfied is also considered for the purpose of amalgamation. Okay, the nature will turn to be purchase nature. Once we make this bifurcation, so now we understood that AS 14 tells purchasing company has to now bifurcate the nature. Why are we bifurcating it? Because the accounting methodology depends upon this nature. Now, what accounting methodology we need to follow? So, if at all we follow nature of merger, the method applicable will be pooling of interest method. If it is purchase, the method applicable is purchase method. Okay, so 2 factors will arise now, 2 types of methodology through which amalgamation accounting should happen. So those 2 methods we need to now learn in detail. Now, what factors are we supposed to consider? I have considered the major factors we need to consider and also the journal entries which works along with it. The first thing, if I am following pooling of interest method, what factors will I incorporate? Okay, so what factors do we incorporate if we follow pooling of interest method? You are allowed to incorporate non-current asset, current asset, which means you are allowed to incorporate total assets, but you are also allowed to incorporate liabilities along with reserves and surplus. So we are allowed to incorporate reserves and surplus in pooling of interest method. If you want to understand what is the logic behind it, you just imagine those 5 conditions which is provided, where there is all assets, book value, equity shareholder of selling company will become shareholder of purchasing company. For these people, the consideration is paid in the form of shares, the business is continued. So it is as if the old selling company has got a new name and it is still continuing with the same shareholders with the same valuation as well. So therefore, whatever profits are achieved by this selling company is allowed to be created in the purchasing company as well. Okay. However, if I follow purchase method where any one condition is not satisfied, automatically what happens over there? Either you don't take all the assets or you don't take it at book value, or you will not call all the shareholders to become shareholder of your company. So you start getting out of one or the other mechanism. Now, instead of you merging your companies, you are just selecting what is required. You are choosing what is needed. That's why you are allowed to incorporate assets and liabilities, but R&S is not allowed to be incorporated. So you are not allowed to incorporate the profits of the selling company in purchasing company. Pooling of interest method, it is allowed. Purchase method, it is not allowed. Next, some journal entries which arises over here, which is very common, which will repeat most of the time in your exam. First one is the purchase consideration due. So the consideration gets due. At that time, what entry will come? It is business purchase account debit to liquidator of selling company account. Okay, same entry has to be passed even in purchase method also, where business purchase debit, basically business is coming in and liquidator to whom we need to pay the consideration. Liquidator will come in between. He will take the consideration from the purchasing company. He will distribute it to the selling company. So we owe it to the liquidator. We pay liquidator in the future. Next, once the consideration becomes due, we are supposed to acquire the assets and liability and incorporate it. So what is the incorporation entry then? For that, it is asset account debit to liability to business purchase. This is common. You can find it over here also. Assets to liability to business purchase. However, if at all, for example, let's say the total asset is 500, total liability is 300 and purchase consideration is 200. Which means I am acquiring 500 worth assets, I am acquiring 300 worth liability, which means I have to owe it or I have to pay it to the people in the future. Which means what is the net benefit I have taken from the selling company? 200. To take this benefit, how much am I paying? 200 again. Now in this situation, there is no profit and no loss. Entry will remain the same. You can just write asset account debit 500 to liability 300 to business purchase 200. It automatically got tallied. However, this normally doesn't happen in our day-to-day life. In our practical understanding, whatever might be the asset minus liability value, the consideration what we may pay will obviously differ. At that time, if you are paying more consideration, if the consideration is more, then it leads to loss. If consideration paid is less, it leads to gain. And this loss is transferred to goodwill account in case of purchase method, and this gain will be transferred to capital reserve if at all it is purchase method. So purchase method, the loss on takeover is shifted to goodwill, the profit on takeover is shifted to capital reserve. However, in case of nature of merger, both profit or loss will be adjusted to reserves. Okay, there are different mechanisms through which the reserve adjustment will take place, but however, the final conclusion is whenever there is gain or loss in pooling of interest method, it will be adjusted to reserves. But when it comes to purchase, it will either go to goodwill account or it will go to capital reserve account. The next part will be discharge of the consideration. So this entry is all about discharge of purchase consideration, and accordingly, when it comes to purchase method, the discharge can take place in any form and it can go with any type of security. So therefore, liquidator account gets debited where credits are given to different types of securities, where there is equity share, preference share, debentures, and these shares can be issued at par or premium. So if they have issued at premium, then securities premium account will come into the picture, and finally if they want to pay off, then cash or bank. However, if you consider pooling of interest method, and if we remember the fourth condition of nature of merger, we remember that it should be the consideration to equity shareholders should be paid only in the form of equity shares, and any fraction shares can be paid in cash. So accordingly, for equity shareholder, it will be only equity share capital. If it is issued at premium, then securities premium account and cash or bank account. So for preference shareholders, it can be paid in any mode. So therefore, all modes are considered for PSH. So for equity shareholder, it will be given only in the form of equity share, fraction, cash, but preference shareholder, it can be given in any form. So that has been considered over here. The next thing is, if at all there is any liabilities taken over, and if we are replacing the liability, let's say that we have taken over the debentures of selling company, we are issuing our debentures to replace it. At that time, this entry will come into the picture, whereby debentures account debit, where old debentures whichever is taken over, that gets debited. Credit is given for cash or bank, or new debenture. If it is issued at premium, then SP account. So how they have discharged, the question will tell you. You have to consider what the question has given, and accordingly how do you apply here. The same thing applies for purchase method also. There won't be any difference here. Next thing, if at all there is any amalgamation expense, and if that expense is paid by the purchasing company, at that time, whatever account you created in the incorporation, if at all you check here, whatever accounts you have created in incorporation, that account is utilized whenever you consider the payment of amalgamation expense. Suppose if you go with purchase method, the incorporation might either lead to goodwill or it might lead to capital reserve. So that account gets debited. So in incorporation, if goodwill got created, then debit goodwill here. If at all capital reserve got created, debit capital reserve here. So both will be debited. Any one account, whichever is considered from incorporation point of view. Then reserves, because if again in incorporation of pooling of interest method, profit or loss is adjusted to reserves. So therefore reserves account debit to cash or bank. Next, sometimes there will be mutual balances. And in case of mutual balances, let's say for example, there is A Limited and there is B Limited. And A Limited have made sales to B Limited. In that case, for A Limited, B Limited will be debtors. For B Limited, A Limited will be creditors. Isn't it? Because there is a credit sale. Now, if at all amalgamation will take place, creditor will be taken over by the purchasing company. So both debtor is also in the purchasing company, creditor is also in the purchasing company. So I can't take amount from myself. For that reason, these mutual balances should be cancelled. How do you do it? Debit the liability account, credit the asset account. So creditor account debit to debtor account. This can happen with bills also. Bills payable account debit to bills receivable account. So whatever mutual balances they have, that has to be cancelled, because post amalgamation there is only one balance sheet. In that balance sheet both debtor and creditor will come now. That cannot happen. So for that reason the cancellation will take place. And again it will remain the same whether it is purchase method or pooling of interest method. The next thing, the concept of stock reserve applicable over here. Let's say that again there is A Limited, there is B Limited. A Limited has made sales to B Limited, and accordingly now B Limited have still these goods, or these goods are still with B Limited in stock. Now post amalgamation A Limited will take over this stock also. B Limited's cost is A Limited's selling price. Correct? Because A Limited made sales to B Limited at their selling price. For B Limited it is cost. Stock will be valued at cost to B Limited. Now A Limited is taking over the stock. So A Limited valuation, what they are applying to take over the stock, is B Limited cost, A Limited's selling price. Why are we specifically mentioning the selling price here? Because selling price is cost plus margin. And we know that whenever there is internal amounting involved, you cannot have margin in it. So therefore, the margin portion gets removed by creating the stock reserve account. That is the concept of stock reserve. Okay, so basically there is mutual transaction which has taken place, and for one party it will remain as closing stock. So whatever closing stock is there, it is recipient's cost, sender's selling price. So either of one of the companies is having their selling price there. If there is selling price, then margin is included. So for that reason we apply stock reserve to remove the margin part. When are we allowed to close the stock reserve? In the next year when you are going to sell it off. As soon as you sell off your stock, you can reverse the stock reserve. But currently it is creation point of view, because we are still taking over the assets and liability. For that reason stock reserve has to be created. What entry should we pass for stock reserve then? Stock reserve reduces our profit. So therefore, since it is at the time of amalgamation, if you again go with purchase method, it is goodwill or capital reserve. Okay, just like amalgamation expense, whatever account you considered in incorporation, that account will come here. Again in pooling of interest method, it is adjusted to reserves. That's how we need to consider this. The next concept is in connection with statutory reserve. See, the thing is, if in case of amalgamation in the nature of merger, you are allowed to take over assets, liabilities and R&S. So one of the part of R&S will be statutory reserve. So what is statutory reserve? Any reserve which is supposed to be created due to different law. So there are different statutes which instruct you to create a particular reserve. That reserve will be called as statutory reserve. Let's say, for example, income tax law asks you to create investment allowance reserve for a certain number of years. In that case, that is also a part of R&S, but it will be called as statutory reserve because it is asked by the government. Accordingly, whenever you consider pooling of interest method, all R&S will be taken over from the selling company and it gets incorporated in the purchasing company. Because of which, it's already been incorporated in entry number 2. So therefore, no need for a separate entry in pooling of interest method. However, if you consider purchase method, R&S is not a part of incorporation in purchase method. Therefore, statutory reserve will be incorporated now. Statutory reserve gets credited, but we need some debit for that, and for that reason amalgamation adjustment account comes into the picture. How do we present this in the balance sheet? Basically under R&S head, we directly write the statutory reserve amount less amalgamation adjustment, and automatically in the outer column it will be nil. So when we present it in the balance sheet, the amount automatically will be nil, but accounting point of view, it is amalgamation adjustment account debit to statutory reserve account. So statutory reserve 5 lakh less AA 5 lakh, outer column nil. Okay, so concept wise, pooling of interest method is already a part of incorporation, so it's already included in incorporation entry itself. But in purchase method, R&S is not a part of incorporation, but statutory reserve should be maintained because it is asked by the government to do so. For that reason, we pass a separate entry as amalgamation adjustment to statutory reserve. Okay, so these are the major important journal entries when it comes to transferee company, purchasing company, where we apply AS 14 to incorporate the assets and liability and record the payment of purchase consideration. Okay, now the next type of company we have, which is the transferor company, also called as selling company. What accounting directions we find when it comes to this? First, in purchasing company, it was acquisition of assets and liability. Here it is transfer of assets and liability. So we being the selling company now let's imagine from the selling company point of view, we will be shifting our assets and liabilities to purchasing company. Then we are the company who will receive the purchase consideration. We are the recipient. Payer is purchasing company, we are the recipient of it. Very important thing, AS 14 will not apply to a selling company. AS 14 is applicable only for purchasing company, not for selling company. A question comes then, how do we account for selling company? It will be accounted according to GAAP, generally accepted accounting principles. So we will not follow AS 14 principles, we will be following the GAAP principles. Finally, accounting will remain the same irrespective of nature. Why this statement comes in, tell me? Because in case of purchasing company, AS 14 will apply, and AS 14 says there are two nature, merger and purchase, and accordingly account it. Here AS 14 will not apply, therefore accounting will not have any impact on the nature. So nature doesn't apply when it comes to selling company. You have to be very careful on this. If whether it is merger or purchase, accounting will remain the same when it comes to selling company. Accounting will differ based on methods of pooling of interest and purchase method when it comes to purchasing company. In selling company, that doesn't arise. Okay. Now let's see what accounting will come into the picture. Again, as I have said, same irrespective of nature. As discussed, selling company or transferor company mainly is involved with shifting the assets and receiving the consideration, and therefore the last thing which happens in selling company is it gets liquidated. For liquidation purpose, the major account we create is realization account, whereby we use this account to close the assets and liability values so that automatically. Now, when do you say that the books of accounts are liquidated? When all accounts in the books, when it turns zero, then we say that the books of accounts are closed. You should not have even a single rupee balance in any account. If you have a balance, automatically the account is still alive. Automatically your books of accounts are not closed. If I have to get myself liquidated or if I have to get my company liquidated, then automatically all accounts in the books has to turn zero. One of the primary accounts we use for that is realization account. Okay. Now, realization account, how do we prepare them? First, all the assets and liability taken over are shifted to realization. What if the assets and liabilities are not taken over at that time? The selling company will by itself either realize the assets or settle the liability. Okay, all assets taken over, we shift it to realization. Assets not taken over or liability not taken over, at that time it will be directly done by the selling company itself, where they will realize the asset and settle the liability. Okay, now even when the assets are taken over, assets and liabilities are taken over, point to be remembered, we need to exclude shareholder related accounts. For example, equity share capital account, preference share capital account, R&S accounts like P&L, GR, all those accounts have to be excluded. Then fictitious asset needs to be excluded. Miscellaneous expenditure to be written off should be excluded. These three things needs to be excluded whenever you deal with this. Okay. Now you shift it to realization. Asset account shows debit balance. So to close it, we credit the asset account. Liability shows credit balance. To close it, we debit the liability account. Shift it to realization. If at all it is not taken over, as I have said, the selling company itself will close the accounts by either realizing the asset or settling the liability. In that case, any profit or loss on that should be shifted to realization. Okay, for example, debtor, the balance sheet value is 50,000, but actual receipt is 45,000. At that time, what happened? There is a 5,000 loss. This loss should be shifted to realization. When is this? If debtors are not taken over by the purchasing company. If it is taken over, then automatically that value will go over there. Okay. Now, one question comes in. What value should we consider when we shift it to realization? The value what we need to consider at the initial stage of closing the asset and closing the liability is book value. Not the agreed value, but the book value. Okay, simple logic. If I have an asset account, let's say fixed asset account 5 lakh. If you change the value and write it in realization, the fixed asset account will still have a balance now. That should not happen. I have to close the fixed asset account completely. In that case, what should I do? The amount available in the balance sheet, the same amount if you pass a reversal entry or an opposite entry, automatically the amount will turn zero. So fixed asset account is showing a debit balance of 5 lakh. So if I have to make it zero, I have to credit fixed asset account with 5 lakh only. Okay, so for that reason, you need to consider book value. Over here, when it comes to the self-realization of the assets, bank will go with the actual realization, asset account will go with the book value. Difference will be shifted to realization account. Okay, now this entry is asset taken over, the next entry is liability not taken over. Whereby the principal will remain the same, we will only settle it. If there is any profit or loss, it should be shifted to realization. Next, this entry is in connection with purchase consideration due. We are the recipient of it. So therefore, it is purchasing company account debit to realization. Purchasing company, if you are debiting it, it shows that there is a receivable figure from the purchasing company. For that reason, this entry will be passed. Then, any profit or loss on realization should be shifted to the ultimate risk bearers, which is basically ESH. If it is profit, then realization to ESH, opposite entry in case of loss. After that, once the realization aspect is complete, then we consider all the other aspects. What is that other aspect? In realization, we pass the entry for purchase consideration due. Now we will be passing the entry for receipt of purchase consideration. How do you receive it? It can be received in any mode. If it is nature of merger, then ESH will be collecting only equity share. But in purchase, anything can be collected. So therefore, preference shares in purchasing company debit, equity share in purchasing company debit, debenture debit, cash or bank debit to purchasing company account. Any mode that will be decided from the question point of view whenever they give the question to us. Okay, but those accounts will be debited. Credit is given to purchasing company. Next, these whatever securities are collected is not for selling company, because selling company anyhow is getting liquidated. Why are they collecting anything now? Whatever is collected should be distributed to the owner of selling company. Who are the owners of selling company? PSH and ESH. Okay, so whatever consideration is collected, this is distribution of consideration now, and it will be distributed to the respective people according to the agreement what has taken place between purchasing company and selling company. Okay, and accordingly all those securities which we debited before will be now credited. Debit is given for whom it is paid, which is ESH and PSH. Once you distribute it, only the shareholder related accounts will have a balance now. Those balances will be closed out, where preference share capital will be shifted to preference share holders. However, one example, let's say that there is 1 lakh preference share capital, but the consideration we are paying to them is 1,40,000 consideration payable to them. If you imagine PSH account, the entry we pass will be by PSC 1 lakh and 2 preference shares in purchasing company account 1,40,000. Now there is a difference of 40,000. What should we do with that? Now there are two ways in which this will be done. That 40,000 whatever balance you have, either it can be shifted to realization. In that case you need to wait when you want to balance the realization account, shift this also and then balance it, or else directly shift it to ESH. This is basically an option available. We can generally go with the second option itself, because you can finish off realization, shift PSH whatever balance is there directly to ESH, because generally we do the ESH account at the end. From the ledger point of view is what I am telling you. Then equity shareholders, whatever values you have, that has to be transferred, where capital reserves to ESH. In case if there are any debit balances like P&L loss or any fictitious asset, that comes as ESH to the asset values. Okay, whenever you are preparing the ledger account, the final thing to be remembered, the ESH account has to tally. You have to make sure that ESH account gets tallied. If it doesn't get tallied, then some or any one account has a balance now. You need to close that balance, then only amalgamation or liquidation gets completed. For that reason, the last account, whatever you do, generally we do ESH account, that account has to tally. Okay, so this is the accounting methodology which we need to consider when it comes to selling company. The next thing is in connection with purchase consideration now. Accounting, we know purchasing company is a payer company, selling company is a receiver company. How do we account them? We have seen in our previous timings. Now let us see how do you calculate the purchase consideration and what methodologies we have in calculating this consideration. First thing, from the meaning point of view, purchase consideration will be paid by someone and it will be paid to someone. And it is paid by purchasing company, paid to selling company, but not selling company directly. It is owners of the selling company. So the ultimate beneficiaries are owners of the selling company. And this can be given in any mode. Yes, but point to be remembered, if they want it to be considered as amalgamation in the nature of merger, then they have to pay only in the form of equity share. However, in any other mechanism if you see, because amalgamation includes both merger and purchase, for that reason it can be paid in any mode. Okay. Now, how do we calculate the purchase consideration? What methods we have? First method is payment method. When do you apply payment method? If amount of consideration and mode of payment both are available, then we apply payment method. For example, selling company has 40,000 equity shares. Okay, our company decided for every 2 equity shares of selling company, we will issue 1 equity share of purchasing company. Automatically what happened now? Mode has been defined. Okay, so if 40,000 shares are there with selling company, then purchasing company will issue 20,000 shares. We got the mode. And also the question will tell you each share is issued at 20 rupees. Automatically you got your consideration as 4 lakh and then apply payment method. Any one data is not given, then you cannot apply payment method. It is not allowed. Okay, both amount and mode data should be clearly given. Then we will apply payment method. Clearly in the sense it can be direct or indirect. For example, whatever I said before is an indirect way. They are not directly telling you that 20,000 shares are issued. They just said for every 2 of selling, 1 of purchasing is given. For that reason, indirectly they gave the data, we calculated it, but the point to be considered is both data should be available. Okay, let's say they might tell you that 20,000 shares are issued, but balance is paid in cash. How much is the value? Not given. Automatically you can't apply payment method. Okay, so to apply payment method, you need to get that amount figure and the mode of payment clearly. Then only it can be applied. Point to be remembered, whenever you calculate the purchase consideration, when you have the number of share, when you want the value, always multiply with issue price. Okay, whenever you want the purchase consideration, it is always based on issue price. Example, 10 rupees the value of 1 share and we are issuing 15. We are issuing the share at 15 rupees. So the issue price is 15. Now in this regard, in the same example I gave you, it should be 20,000 into 15 but not 10. Okay, not the face value but the issue price. Now we might tell the additional value, where will it go? For the issuer, it will be shifted to the securities premium account because we are issuing the share at premium. So that is the way in which you need to understand and apply the payment method. The next thing, net asset method. When do you apply net asset method? If payment method cannot be applied, we apply net asset method. And accordingly, how do you calculate purchase consideration? Assets taken over at agreed value minus liabilities taken over at agreed value. Point to be remembered, agreed value, not book value. Whatever value they decided between the companies in under negotiation, that value has to be considered for purchase consideration. Logical, it has a very simple logic that if at all I am entering into an agreement, you should consider the agreement value. Agreement value is agreed value. Next, there is one more thing called as intrinsic value mechanism of purchase consideration. Now, intrinsic value is basically internal value of the company, and that internal value is basically the net assets. So, it will follow the same net asset principles. However, the exchange has a different mechanism. In payment method and net asset method, what did we consider? We considered the issue price and accordingly we calculated the amount of purchase consideration. But when it comes to intrinsic value mechanism, at that time we exchange based on our respective intrinsic value. So for the intrinsic value of selling company, purchasing company will issue the shares based on their intrinsic value. In that case, how do you calculate the number of shares to be issued then? It is number of shares of selling company into intrinsic value towards the selling company divided by intrinsic value of purchasing company. How do you calculate intrinsic value per share? It is basically amount available to shareholders or equity shareholder divided by number of equity shares. That is how we get 1 share ka intrinsic value. Okay, where it is amount available divided by number of equity share. Now what is amount available? It is under agreed value. Basic idea is if at all you sell your assets today, how much value do you get? If at all you settle your liabilities today, how much value you are supposed to pay? Whatever difference you take, the amount which will remain, that is the amount available to shareholders divided by number of shares will give you intrinsic value. So internally, if we dissolve today, what is the net value available to shareholder? That is applied over here. So for the intrinsic value of selling company, we will divide it by the intrinsic value of purchasing company, where we will get the number of shares to be issued in this regard. Okay, so that's how the intrinsic value mechanism will work. Now this intrinsic value can be set from liabilities point of view, it can be set from shareholder point of view, it can be set from equity shareholder point of view. What is the intrinsic value from liability point of view? See, if I want to tell from liabilities point of view, you are not allowed to pay your shareholders debt. Before paying the liabilities, what is the value for the company? If you are not paying liability, obviously you can't pay shareholder, because shareholders are allowed to be paid only after liability payment. Therefore, if any amount applicable to liability holders before their payment, automatically that is total asset. So total asset will become the intrinsic value amount from liability point of view. If it is shareholder point of view, before paying shareholders, what is the value available with the company, which will be total asset minus outside liability. That will be the intrinsic value amount. Finally, ESH point of view, it will be any amount or amount available with the company before paying ESH. So therefore, it will be total asset minus outside liability minus preference shareholder payment. And generally in the exam, if they are asking you per share intrinsic value, they normally consider ESH point of view. Amount wise they can ask anything. They might say that intrinsic value amount from shareholder point of view. At that time, total asset minus outside liability. Suppose if they are specifying per share, at that time they normally consider the ESH perspective. Okay, so everything will remain the same. It is net asset mechanism only, because if you check here, total asset minus outside liability at agreed value is net asset formula. So for that reason, we follow the net asset mechanism itself. However, the difference lies in the exchange principles what we adopt. Okay, so that happens from the intrinsic value mechanism. So from amalgamation, from revision point of view, theory perspective, the thing what you need to consider over here would be, one, check the accounting requirement from the purchasing company point of view. Second, check the accounting requirement from the selling company point of view. Third, how do you calculate the PC value? Okay, but technically speaking, from your exam point of view, first you need to calculate the PC, then only you can decide what accounting entries will pass in both the books. However, theory wise, this is how we need to learn, so that we will get clear idea about how amalgamation needs to be done. Exam wise, they can ask a 10 mark question, 15, 20 or even 5, because a lot of things, if you check the theory, there are a lot of things which comes up. So therefore they can target for any marks possible. The thing is, you have to follow these theory first, so that you can apply this theory in a better way in the problems point of view. Okay, so this is the end of the theory understanding of amalgamation. How do you consider amalgamation, what factors needs to be taken up, etc. And then automatically we will take up the problems. So just apply whatever theory we studied and apply it over here. Before we jump into the problems, only one thing which I want to take up over here now. Purchasing company, if you take up, the accounting depends upon nature, which is merger or purchase. Merger, pooling of interest method. Purchase method. A purchase method, you are allowed to incorporate lesser factors. Pooling of interest method, you are allowed to incorporate more factors. So one point which we need to remember is, if it is nature of merger, you can apply pooling of interest method. And if you don't want to apply pooling of interest, you are also allowed to apply purchase method. But follow the rules of those respective methods. In case of merger, if you want to apply pooling of interest method, then total asset, outside liability, R&S, all three are allowed to be incorporated. If at all you want to apply purchase method, then we will only consider total asset and outside liability. You will forget about R&S. Now you might ask me, sir, why they will leave up R&S? Suppose if there are losses and they don't want to take over, they might leave losses at that time. Even though it is merger, they may apply purchase method also. Because purchase method is some way of narrowed mechanism because they are not allowed to take over R&S. But pooling of interest method is allowed to take over R&S. Therefore, you have got a choice. You want to follow any of the two, you are allowed to do so. However, if the nature is purchase nature, then only purchase method you have to apply. You can't apply pooling of interest method over there. Okay, so therefore, sometimes in the exam, even though all conditions of merger is satisfied, then also they might ask you to follow purchase method. It is always allowed. However, if the nature itself is purchase and if they are asking pooling of interest method, that cannot happen. Because that is not allowed by the standard. Okay, so this is the total principles which we studied, total understanding we took up from the perspective of accounting and calculation. Now let's apply these principles and see how a problem can be faced and how it can be taken up. Let's take up the first question now. Let's read the question. The financial position of two companies, Hari Limited and Vayu Limited, as at 31st March 23 was as under: equity and liabilities, shareholders fund, share capital, R&S, non-current liability, long-term provisions, current liabilities, trade payables, assets, non-current assets, property, plant and equipment, intangible assets, current assets, inventory, trade receivable, cash and cash equivalent, notes to accounts, share capital, equity shares of rupees 10 each, 9% preference shares of 100 each, 10% preference shares of 100 each, R&S, general reserve, long-term provision, retirement, gratuity fund, property, plant and equipment, land and building, plant and machinery, intangible assets, goodwill. Hari Limited absorbs Vayu Limited on the following terms: 10% preference shareholders are to be paid at 10% premium by issue of 9% preference shares of Hari Limited. So 10% preference shareholder to be paid at 10% premium, issue of 9% preference shares of Hari Limited. Goodwill of Vayu Limited is valued at 50,000, building valued at 1,50,000 and machinery at 1,60,000. Inventory to be taken over at 10% less than book value and provision for doubtful debts are to be created at 7.5%. Equity shareholders of Vayu Limited will be issued necessary equity shares at 5% premium. Prepare necessary the acquisition entries in the books of Hari Limited. Also draft the balance sheet after absorption as at 31st March 23. So this is the question. This is a recent MTP question which we have. So accordingly what they have said is they have asked two things over here. One, they need the acquisition entries. Second, they need balance sheet after absorption. Okay, so these two things are needed, which means acquisition will be made by the purchasing company. So journal entries in the books of purchasing company. Then balance sheet after absorption, which means purchasing company itself. Selling company will not have balance sheet after absorption because you are going to close and liquidate the selling company books. Now accordingly, what are we supposed to do then? How are we supposed to consider this? First thing is, whenever we deal with a question based on amalgamation, we need to see where the entries will come into the picture. Once you are done with that, next check whether amalgamation is in the nature of purchase or whether it is in the nature of merger. Now if you look into this, purchase and merger, we have to remember those 5 points. All 5 points satisfied will become merger. Anyone not satisfied automatically will become purchase. Now if we look into this, look into the scenario, 10% preference shareholder are to be paid at 10% premium by issue of 9% preference shares of Hari Limited. Fine. Goodwill is valued at 50, building is valued at 1,50,000 and machinery at 1,60,000. They are changing the book value. Now if we remember the merger conditions, You are not supposed to change the book values. It should be taken over only at book value. Only exception is to create the uniform accounting policy. But here there is no uniform accounting policy as such. Here the target basically is in connection with the valuation changes itself. Therefore, automatically it will become purchase. Amalgamation is in the nature of purchase. Now, once we decide the amalgamation nature, now we know that acquisition entry should be passed according to purchase method. And now the very next thing which is very important now is to calculate the purchase consideration. What purchase consideration do we need, or what is the value of purchase consideration over here? Now for that, mainly point A and point D is going to tell us this particular thing, where how much purchase consideration will come into the picture. Now accordingly, whatever factors we have considered here, point A is telling us that 10% preference shareholder are to be paid at 10% premium by issue of 9% preference shares of Hari Limited. So our company will issue 9% preference share to the selling company at 10% premium. So accordingly, the takeover is to be made at 10% premium because they are paying at 10% premium, and we are giving 9% preference share in that place. Now if we look into the selling company preference share capital, which is basically Vayu Limited, the preference share capital of Vayu Limited is 1 lakh. This should be taken at 10% premium, so automatically it became 1,10,000. So this 1,10,000 will be the amount we have to take over when it comes to preference share. So value is understood here. It is basically 1,10,000. After this, if we now look into point number D, equity shareholders of Vayu Limited will be issued necessary equity shares. So necessary equity shares basically means we know the mode of payment but we don't know the amount. How can we define necessary? It's not possible. Therefore, since specific data is not available, automatically we have to apply net asset method. We can't apply payment method here. We have to apply net asset method. Okay. Now, if at all we follow net asset method, then what will be the consequence? First thing we know, when it comes to how much purchase consideration it will be total asset at agreed value minus outside liability at agreed value taken over. Whatever is taken over will be considered. Then, whatever purchase consideration you get will be the total purchase consideration. This will be broken up into mode of payments. And we know that purchase consideration is payable to owners of the company, which means I will ignore debenture holder payment. I will only consider the shareholder payment. Over here, one is PSH, the other one is ESH. For preference shareholders, preference shares are given and we already know the value 1,10,000. For equity shareholders, equity shares will be issued at 5% premium, but we don't know what is the amount. That amount, first we have to calculate the purchase consideration. Once we deduct 1,10,000, you will get the balance amount to be paid to equity shareholder. For that purpose, point number B and point number C has been given for us, where they gave a different valuation for certain assets. Now let us see. Goodwill 50,000, building 1,50,000. Let's make the applicability over here itself. Goodwill 50,000 intangibles, and building has turned into 1,50,000, which is property, plant and equipment. Over here I think there are two things. Correct? Yes. So land and building is 1,50,000. Then what else have been mentioned? That is the end of point number B. No, machinery at 1,60,000. So property, plant and equipment itself plus 1,60,000. After that, according to point number C, inventory to be taken over at 10% less than book value and PBD to be created at 7.5%. So inventory to be taken over at 10% less than book value. So this inventory will be 1,75,000 minus 10%. And trade receivable will be 1 lakh minus 7,500. PBD they want you to remove. Okay. So this will be the scenario what we are supposed to apply now. So other than these assets, whether all assets are covered, yes, cash and cash equivalent will remain the same at book value 20,000. Okay. After that, the liabilities will come up, where consider only the liabilities taken over. Since nothing is mentioned, our assumption is all liabilities are taken over at the same value. So 20,000 here and 80,000 here. So just for our understanding, let's quickly look into the solution part. Yes. So as discussed, goodwill at 50,000, 1,50,000 for building, 1,60,000 for machinery, inventory 10% reduction, so 157,500, trade receivable 7,500 reduction, so 92,500, then cash at bank at 20,000. Then to liability, if there is a revised valuation for that also, consider the revised value. Here not available, so directly the book value 20,000 and 80,000. So the total purchase consideration is 5,30,000. Okay. So in the chart what we had taken up, so the total purchase consideration is 5,30,000. In this 5,30,000, as discussed, 1,10,000 is for PSH, which means balance 4,20,000 will be for ESH. Okay, so that is how we got to consider the factors in connection with purchase consideration. After this, how many shares are we supposed to issue? Check point number D. These equity shares are issued at 5% premium. If we look into the share capital note, equity shares are of 10 rupees each. And if it is issued at 5% premium, correct? So 10 rupee is per share value and it is issued at 5% premium according to the question. So divided by 10.5 will give us the number of shares over here. Okay. So again, if we look into the solution part, equity shareholder of Vayu Limited to be satisfied by issue of 40,000 equity share issued at a premium of 5%. So this is the way in which the purchase consideration is calculated. So the total is 5,30,000 divided into 1,10,000 and 4,20,000, each share 10.5. So 40,000 shares will come into the picture. 40,000 into 10 will go to share capital, 40,000 into 0.5 will go to SP, securities premium. Okay. Now, once we know the purchase consideration, let us take up the actual answer what they have asked, where they are asking the acquisition entries in the purchasing company. What entries will come? Number 1, purchase consideration due. Let's look into the entry directly to learn this correctly. Yes. So the first entry is business purchase account debit to liquidator of Vayu Limited account. That is our first thing. Business purchase to liquidator, purchase consideration due, total 5,30,000. After that, incorporation entries will start. Now, point to be remembered. Whenever you pass the incorporation entry, if at all you follow payment method for purchase consideration, then goodwill or capital reserve will be the balancing figure. First of all, goodwill and capital reserve will come here because it is amalgamation in the nature of purchase. If it was merger, we would have adjusted to reserves. But here, that is not the case. We need to now take up goodwill or CR because it is purchase. And if it is payment method, pass the entry, leave space, balancing figure will be GW or CR. Suppose if you are following net asset method, which is basically asset minus liability, and in the net asset method itself, if you have already defined goodwill, then the same amount of goodwill will be applicable for incorporation also, because asset minus liability is equal to PC. So for that itself gets converted according to the requirement of the journal entry. Okay. So accordingly, goodwill account debit 50,000 as discussed, building 1,50,000, machinery 1,60,000, inventory 157,500, trade receivable they have considered 1 lakh. Why? Because they want you to create 7,500 provision, and provision is a separate account. For that reason, 1 lakh we will be taking up as debit, total debtor, and a new provision account will be created. Instead, if they had said bad debt, then reducing from trade receivable is okay. Since they have mentioned it as provision, provision is a separate account. For that reason, it goes to credit end. So, if we look into bank account 20, then credit is given for one, the long term provision, so retirement gratuity fund, then trade payable, then provision for bad debt. As discussed, provision will come as a separate account. Then business purchase. Okay, so that is how you got to consider when the incorporation comes into the picture according to net asset method. And if you look into the journal entry now, it is as if the same net asset table which we had created to calculate PC, that itself has got converted to a journal entry, because everything will be recorded in the incorporation entry at agreed value. Next, discharge the purchase consideration, where 5,30,000 is the total. In that 1,10,000 will be given as preference share, that to 9% preference share. Then 4 lakh will be given to equity shareholder, because it is basically 40,000 into 10. Then securities premium will be 40,000 into 0.5, because 5% premium issue. So that will become discharge part. So once we are done with this, automatically the journal entries are over. Suppose if they said the debentures, if there are any, we are getting it replaced, then automatically the replacement entry will come. Or mutual balances, if they have like debtor creditor, then the cancellation entries will come. Suppose if there is unrealized profit in the stock, then stock reserve entry will come. Those are situation based entries. Point to be remembered, the first three entries which we studied, basically business purchase to liquidator, incorporation, discharge, these three entry will come in all amalgamation problems. Fourth entry onwards, it depends upon the situation. If the situation is asking you to follow, then follow. Otherwise, you can leave that. Okay. So this is about the mechanism we have to follow in the journal entry aspect. The next thing is we need to create the balance sheet. Since this is an absorption question, there is already an existing purchase company, which is Hari Limited over here. That is acquiring the selling company, which means whatever agreed value at which they are taking over, add that to already existing balance of purchasing company. Only exception would be R&S, because R&S of selling company is all not allowed to be taken over. Okay, so if we quickly look into the way in which the balance sheet framework might arise. Okay, now when it comes to share capital, for example, already Hari Limited has 11 lakh. Correct? Now, two types of shares we are issuing. One is preference share to preference shareholder worth 1,10,000. Then 4 lakh worth equity shares. These two gets added to 11 lakh. So automatically we get the new share capital. Then when it comes to R&S, the equity shares were issued at premium, which means for the 70,000, 20,000 SP account will be added. So what R&S revision can take place? Tell me. One, purchasing company, whatever R&S they have, that will be retained. Second, if it is nature of merger, I'll quickly write it down for you for easy learning. So one R&S of amalgamated company will be one purchasing company R&S, which they already have, plus if amalgamation is in the nature of merger, then R&S of selling company will also come up. That gets added to purchasing company. Amalgamated R&S will come. Suppose if it is purchase, then at the time of acquisition, if there was any capital reserve, that will come into the picture. Then in both situation, suppose if the shares are issued at premium, then this premium, securities premium basically will also come. So these four things can be added up to get your final R&S. Okay, so one, already the purchasing company what they have, adjustment if required. Then merger, if it is nature of merger, then selling company R&S is also allowed to be incorporated, so that will be added. Suppose if it is nature of purchase, then acquisition will either lead to goodwill or CR. So CR will come here. And in both scenario, anyhow shares will be issued, and if they are issued at premium, then SP will come. Okay, over here only SP will come, because nature of merger, it's not nature of merger. Then nature of purchase, we have goodwill here. We don't have capital reserve. Next, long-term provision, you just have to add these two because it is taken over at book value. Trade payables, again add these two, taken over at book value. Property, plant and equipment, you got to add this with the agreed value now. So add 8 lakh with the agreed value. Then intangible asset, goodwill also add it with agreed value. Then inventories, separate agreed value was there. Trade receivables, separate agreed value, where it will be total trade receivable minus provision for bad debt. And finally, cash and cash equivalent, directly adding the two because there is no difference in the valuation. If you just add these things up, automatically your balance sheet will tally. So now let's look into the solution part of this. See, share capital 16 lakh 10,000, which is basically the 4 lakh of equity, 1 lakh 10 of preference added to the existing capital of the company. Then R&S 70,000 was already there, 20,000 SP. Let's look into the note itself, it becomes easier. So 1,40,000 will become the total equity shares now, of which 40,000 is issued for non-cash consideration. Suppose if the shares are issued for consideration other than cash, then one disclosure is required according to the Companies Act. So that has been followed here. Next, preference share, 1,100 preference shares got added now. So initially it was 1,000, we added 1,100 more preference share, leading to 2,100. Again, 1,100 is also non-cash. Next, R&S, GR and SP. SP basically issue of shares at premium. Then retirement gratuity fund, same thing, but add the two companies. Then trade payables, they are not created a note, but directly over here they are mentioned. Again, add the two companies. Property, plant and equipment, when we spoke about, they have directly taken up the agreed value of both, where book value was already there in purchasing company, added with the agreed value. Intangible asset, goodwill, again addition of agreed value. Trade receivable, less provision as discussed. Cash and cash equivalent will be addition of the two. So if you do things like this, so basically what you are supposed to do is, once you are done with the purchase consideration calculation, check what is actually asked in the question. Once you do that, automatically apply the merger purchase mechanism to understand what it is all about, and then start preparing the requirements. Say if selling company they ask, they normally ask the ledger accounts of the selling company. Then automatically each and every ledger has to come. So realization, purchasing company account, and it moves on. So that factors will come if it is selling company. Purchasing company, journal entries will come. Once you are taking up the journal entries, see the impact on the revised balance sheet. If you are incorporating assets and liability, automatically asset will increase, liability will also increase. But that will be done at agreed value. That agreed value you have to adopt. Then discharge of purchase consideration will impact your shareholder fund or liability, whatever it is. That's automatically, if you make the adjustment, the balance sheet has to tally. So double entry effect, whatever you are taking up, if you know where exactly we need to point it out and write it, then automatically this will become easier for us. Okay. Now let us move into another question. This is targeting the purchase consideration calculation. Okay. Let's quickly read this question. Raman Limited and Naman Limited decided to amalgamate and form a new company, Rana Limited, as on 31st March 23, and provided you the following information. Particulars: as on 31st March 23, Raman and Naman revalued figures for amalgamation, Raman and Naman. Equity shares of 10 each, preference shares of 100 each, R&S, trade payables, property, plant and equipment, goodwill, inventories, trade receivables, cash and cash equivalent. The purchase consideration is to be satisfied as follows. By issue of 4 preference shares of 100 each in Rana Limited at rupees 85 paid up and at a premium of 30 per share for every 3 preference shares held in both the companies. By issue of 5 equity shares of 10 each in Rana Limited at 7 paid up and at a premium of 5 per share for every 3 equity shares held in both the companies. In addition, necessary cash should be paid to equity shareholders of both the companies as required to adjust the rights of shareholders of both the company in accordance with the intrinsic value of the shares of both the companies. you are required to calculate the purchase consideration for both the companies. So a direct purchase consideration based question is asked over here now. That obviously we have to apply and see how the things are supposed to be done. Now when it comes to the requirement of this kind of questions, purchase consideration questions, they normally will give you more than one adjustment and certain statements where it gets confusing. So now let's try to understand. What do you mean by purchase consideration? It is the amount or any securities paid by purchasing company to owners of selling company, where owner will include PSH, ESH. And they are talking about these two only, which means both point 1 and point 2 are a part of purchase consideration. What about point 3? Necessary cash should be paid to equity shareholders. So automatically is it paid to owner of the company? Yes. So even this is also a part of PC. So all three are a part of purchase consideration. Conclusion number 1. After that, look into the terms given in the question. So it is purchasing company giving securities to owners of selling company by any mode. Now in this regard, why purchase consideration is given? Because we are acquiring the business. If you acquire cash from the shareholder to issue this share, it's not PC, it is normal share issue. Example, purchasing company gave 5 shares to owner of selling company by receiving cash worth 5,000. Now automatically what happened here? Here the shares are issued not to acquire business but to get cash. This is not a part of purchase consideration. If it is purchase consideration, the only thing you are going to receive is business overall, which is basically assets and liability. You are not collecting cash from the shareholder. So apply that logic in point number 1 now. By issue of 4 preference shares of 100 each in Rana Limited, which is the purchasing company, at 85 paid up and at a premium of 30 per share. Each share is of 100 rupees, but they are defining that to be of 85 paid up. What's the meaning then? The rest 15 rupees the company can collect in the future. And if they are collecting it, shareholder are paying it. I am receiving cash and I am making it fully paid up. Is it a part of PC? No. Which means 85 is a part of PC. 15 is a part of cash consideration. So automatically what is our learning then? For PC only consider 85, do not consider the rest 15. Apart from that, you have got 30 rupees ka SP also, even that is also a part of purchase consideration. Because SP, if you read it, at a premium of 30 per share, they are directly issuing the share at 30 rupee premium. So automatically why are they doing it? To acquire the business. Here they are not getting cash for that 30 rupees. So therefore it's a part of purchase consideration. Then they have given us the exchange. If you consider selling company and purchasing company, they are saying 4 shares of purchasing company will be issued for 3 shares of selling company. This is the exchange base for us. If there are 3000 shares, then automatically 3000 into 4 by 3. So in that way, cross multiplication to get the number of shares to be issued. But very important, per share we will multiply 115 rupees. Okay, because issue price needs to be multiplied. Same logic apply for the second point now. 5 equity share of 10 each in Rana Limited, 7 paid up, which means PC part will be 7. At a premium of 5 per share, again PC part will be 5, so total comes to 12. What about the rest 3 rupee? Cash consideration will be considered in the future. Okay, so that comes from the equity point of view, where they are, again if I consider selling company, purchasing company, 3 shares of selling, 5 purchasing, and in this exchange basis they are going to consider the shares. Now just to take up one of the examples now, let's consider the first company, Raman Limited, where preference shares are 3,36,000 and it is of 100 rupees each. So how many shares do we have? We have 3360 shares. Apply this in the element we have considered. So 3360, I will just take it up here. 3360, how much? So to get the purchase consideration, it will be into 4 by 3. Okay, same way of applicability will apply for equity shares also. But very important one is the third point. Necessary cash should be paid to equity shareholder of both the company to as required to adjust the right of shareholder of both the company in accordance with intrinsic value of the shares of both the company. Now, let's quickly recall the intrinsic value purchase consideration, where that depends upon exchange, then also depends upon calculation. Intrinsic value calculation is basically net asset calculation, which is total asset minus outside liability, agreed values taken over. Those two things anyhow we have to consider. But the thing, very important thing over here is intrinsic value can be set from different point of view. You can talk it from liability point of view, shareholder point of view, equity shareholder point of view. Liability point of view, total assets. Shareholder point of view, total asset minus outside liability. ESH point of view, total asset minus outside liability minus preference shareholder payment. In this, which intrinsic value should we consider? They are saying intrinsic value of the shares of both the company, which means they are not specifically telling equity shares of both the company, they are just telling shares of both the company. So which point of view should we consider then? SH point of view, not ESH but SH point of view. So how do we answer this then? First, let's calculate the intrinsic value. Once we calculate intrinsic value from SH point of view, how do we calculate total asset minus outside liability? We'll get the total intrinsic value. Compare that with the share based payment, compare that with the share based purchase consideration. If there is any difference, that will be paid in the form of cash. That is the requirement of this question. I hope it is clear. So which point of view of intrinsic value do we consider? Again, look into the question. Question will tell you. Generally, if the exchange is based on intrinsic value, then normally it will be ESH point of view. But if only calculations or valuation is done, then they can ask any point of view over here. Okay. Now, quickly let's look into the solution part. Payable to preference shareholder 115 as discussed into 4 by 3 will be the applicability. For each shares we will apply into 4 by 3. Then equity shares 12 rupees as discussed, then into 5 by 3 will be the applicability. Look into the question. Question gave us the number of equity share, then exchange is 3 of selling, 5 of purchasing. So 5 by 3 have to be applied. Finally, how much cash we have to pay, that depends upon intrinsic value. So intrinsic value is calculated as total assets minus outside liability. Whatever value you get, compare with payable in shares. Whatever balance we get, that will be paid in the form of cash. Okay, so that's how we have to consider the total and cash payment over here. Okay, so whenever PC valuation comes up, how do you consider, what factors will come? Those things are important. Since it is calculation based, it will be easy. The only thing is wordings, you have to be very careful when you look into it. Okay, I hope these questions, when you look into it, we are able to understand this and it is clear for us. With this, we come to the end of the amalgamation chapter overall, where give more importance to that initial theory. Then look into some of the questions. For revision purposes, I have taken only 2. But take up some more questions from your institute material and start learning about it. Once you are clear with that, the chapter will be very clear and it will be easy for you to apply it in the exam. Okay, so don't make any mistakes here. Read the questions correctly and work it out. I hope this topic is understandable and it is clear for us. With this, we'll complete the amalgamation chapter. We are ready. So AS12 talks about government grants. So basically, when government grants has been received by any enterprise, how do they account it in the books of accounts? That is covered by AS12. Reason being, this is one of the amount given by the government whereby the users of the financial statement should know that there is an amount received by any enterprise to that manner. Reason being, this is not something which is earned by the enterprise. This is something which is aided by the government. So to what extent government aids has come into the picture, to what extent the enterprise is using government money, all these things the users ought to know. So therefore, this standard becomes important. Now, what do you mean by government grants? This is basically assistance given by the government with conditions. So basically, government is going to give certain assistance either in the form of cash, in the form of kind. So in cash or kind, any of the two could be given, and they give assistance to enterprise depending upon the situation. And every time when they give a grant, they try to associate that grant with a condition. So government directly just don't give you money or asset or something and directly say use it. No, they will give the asset or money. They will ask you to follow certain conditions. So that's how a grant is normally given to you. Now, few things are excluded when we talk about government grants. So government grants, AS12, the accounting point of it, two major things has been excluded out of it. What are those? Assistance in other forms. Okay, other than the assistance in cash or kind, if any other type of assistance is given by the government, this is excluded from accounting under AS12. Then government participation in ownership. Government purchases shares of the company and for that consideration is paid in the form of cash. Now at that time what happened? Will you call this as grant? Will you cover AS12 here? No. Why? Because they are buying shares, which means they are having an ownership in the company. So government participation in ownership is another exclusion from AS12. Now, so basically now try to understand from the enterprise angle. What is happening from the enterprise angle? Enterprise will receive grant. So amount is coming in, it's an incoming, so it's an income. Now, whenever there is an income altogether, the enterprise has to apply prudence. So who will say that? Standard will say. The standard will say be prudent. For that they said, when can an enterprise recognize the grant received? So recognition criteria. So when can an enterprise recognize grant in the books of accounts? So two conditions. Number one, conditions associated with grant is fulfilled. Second, conditions associated with grant is fulfilled. Second, receipt is certain. Receipt is certain. So two conditions, if both the conditions are satisfied, both the conditions should be satisfied, then you can recognize grant in the books of accounts. What are they? One, whenever a grant is given by the government, they will always associate that with a condition. So therefore, whatever conditions government has prescribed, it could be an ongoing conditions also, but you should be on the line of fulfilling them. If you don't fulfill the condition, no grant will be given to you. So for that reason, you have to fulfill the conditions given in the grant. If they do it, government is ready to pay and it is government. So receipt may be certain, may not be certain. So therefore, if it is certain, then only it is accounted in the books. So that is how you have to deal with the recognition criteria of the government grant. Now, when it comes to the accounting point of view, first I will tell you the overall accounting, what and all is covered in AS12, so that once I actually go into individual discussion of accounting, I can tell all the situation at the same place. Otherwise, we may have to shift the places. Maybe it won't be good for us to read it in a particular way. So therefore, I will tell you the overall accounting of this government grant. Then let's see individually one by one as to how these accounting aspects has to work. Now, from the accounting point of view,
The first thing which will happen is recognition. So we have seen the criteria for recognizing the government grant. Then you should pass an entry for recognition. So that is the first job. Second, if at all there is a refund, then how to account for it. So if you have followed the conditions at the beginning, grant will be given to you, it became certain, then you recognize grant in the books of accounts. But government normally gives an ongoing condition. It just don't tell that fulfill these conditions, I'll give you grant. It tells I will give you grant, even after that also fulfill conditions. Example, government is going to give me money to buy a pollution control equipment. Okay, so government has given us certain directions whereby we need to purchase a pollution control equipment and install in the factory. So for that reason, government paid you say 2 crore rupees for entire installation. Now the point is, you can use directly for that sake only for some days. You can use that 2 crore to buy the pollution control equipment for some days. After that, you may sell the asset or do something else. So just to receive the grant, all the conditions are fulfilled. After receipt, nobody is going to care about it. This shouldn't happen. Therefore, government will give you ongoing conditions as well. Like, for example, it tells you that for minimum of 5 years, this pollution control equipment should be used. Now, at that time, what happened? 5 years you have to use it. Otherwise, you receive the grant, but you don't fulfill conditions after receipt, then what will happen? Refund will happen. So you were supposed to use it for 5 years, but you want to use it only for 3 years. What will government tell? Give my money back. So at that time, refund of grant can take place. Now, first to be understood, refund of grant is an extraordinary item. Refund of grant will always be an extraordinary item. Okay. Now we have to see how accounting of grant individually is supposed to take place. First let's see what are the types of grant. Types of government grant. In that, mainly there are two types of grant. One, we call it as non-monetary grant, and second obviously will be called as monetary grant. Okay, what do you mean by non-monetary? Now don't think about non-monetary definition of AS 11. Okay, AS 11 had a definition for non-monetary item, monetary item, etc. But here we are not talking about that. Non-monetary grant basically means grant in form of asset. Say for example, government will give you patents. Use that patents and you produce the product. One, government will give you land. Use the land. So that's how grant might be given. Grant need not always be given in the form of cash. It could be given in the form of assets also. Those things are called as non-monetary grant. Then second thing what is there is monetary grant. Now what do you mean by monetary grant? This is grant in the form of cash. So instead of giving a land to the enterprise, what government might do? Government might give them money to purchase land. So directly if they give land, it is non-monetary. If they give money to purchase land, it's monetary. Okay. Now, when it comes to non-monetary, there will be two situations. One, you take up the asset at a concessional price. Two, you take up the asset free of cost. Okay. Then in monetary, there are three things. One, the purpose is to acquire fixed asset. The purpose is to pay revenue expenditure and in the form of promoters contribution. So these are the various utilization aspect when it comes to government grant. Okay. Now first thing, it will be given in the form of asset. So it could be given at concessional price or it would be given at free of cost. If at all it is given at arm's length like market price, then it's not a grant in the first place. Government is not giving me any assistance. Instead of buying from the government, if at all I purchased from a third party, the rate would have been the same. So where is the assistance? So for government grant, there has to be an assistance. So therefore, grant will be given either at concessional price or it will be given at free of cost. If at all they give you money for the purpose, at that time what the government is going to do? Government is going to give you money and tell the purpose for which you are taking it up. So either the purpose is to acquire fixed asset or to pay revenue expenditure or in the form of promoters contribution. So one by one now we have to see individual grant and how the entire accounting is supposed to function. The first one, we are in non-monetary grant. I will write it as NMG, and in that, if at all it is received at concessional price. If at all you have received a grant at concessional price. So basically what's happening, 50 lakh is the market value of the land, but government gave it to you at 20 lakh itself because you want to establish a huge factory in that particular area. So what happened now? They gave you a non-monetary grant. Whenever a non-monetary grant is given, that too at concessional price, there is cost. Because you pay something. For example, 50 lakh value ka land is given to you at 20 lakh, which means you have paid 20 lakh, right? Which means there is a cost incurred. Now, that will be considered as value of asset. Okay, for example, as I have said before, land has got a market value of 1 crore. Government charged 60 lakh for you. Now, what happened? Cost incurred is how much? 60 lakh. So, 60 lakh will be the value of the asset. Second, if at all you receive it at free of cost. Now, if you could see here, cost concept tells us that you need to record it at cost incurred. If the asset is received at free of cost, then basically there is no cost at all, correct? If it is at free of cost, then there is no cost involved. Then what should be done? So if there is no cost, should I don't show it in the books of accounts only, or am I supposed to show it? For that they said, show it in the books of accounts, record in books of accounts, but it should be recorded at nominal value, which means immaterial value. Because whenever you write anything in the books of accounts, number should be there, quantity should be there. For that reason, they say that show it at nominal value. Nominal value is something which doesn't affect the decision of the user. So at that value, show that particular non-monetary asset or non-monetary grant asset purchased in the books of account. So this is how you need to deal with non-monetary grant. Next thing what comes is, okay, for this if I have to pass a journal entry, concessional price, what will happen? Asset account debit to bank account. If it is at concessional price. Okay, if it's at free of cost, then what should I do? Normally they don't pass an entry, but if they pass it, they will pass it as asset account debit to reserves account. Because you are not paying anything, you have taken it free of cost. So therefore adjust it towards reserves. Okay, so this is how you need to deal with non-monetary grant aspect. Normally when it comes to non-monetary grant, refund cannot happen. They may ask you to pay the difference amount, but refund doesn't happen. They give you a land. After 4 years, government comes and tells, give my land back. It's not going to happen, right? For that reason, normally refund doesn't happen in non-monetary grant. At most thing what the government can do is ask the remaining value from the customer. So that's how your non-monetary grant is supposed to work. Then monetary grant. Monetary grant, which means receipt is in the form of cash. At that time, this monetary grant could be bifurcated into 3. Correct? As we have already seen, what are those 3? Fixed asset, income, or revenue item, and promoter's contribution. Okay, now in this we have to talk about fixed assets. So what is the situation here? government has given us monetary grant. Government has given us money. How to utilize this money to purchase a fixed asset? That will be there in the terms and all. Which asset could be purchased, which asset cannot be purchased, blah 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 stuff. That will be there in the terms between the grant. But overall, if I have to tell you that whenever there is a grant involved, the point to be considered over here is you are going to purchase it or you are going to acquire it through the grant what is received. Now, when it comes to fixed assets, point to be understood, there are two alternatives through which you can account. One, the first alternative is called as capital approach. Second alternative is called as income approach. Now, the point is whenever you account for it, these are the two types of approaches which is given to us. Now, I will try to explain you one by one. We will try to learn what is that situation all about. Then we will try to learn the journal entries as well. Journal entries will be are of two types. One, recognition journal entries. Second, refund journal entries. So let's try to learn everything in detail now. First, capital approach. Now, what is going to consider here? Here basically you consider grant as capital item. If you consider this grant as capital item, it should come in the balance sheet. Revenue item will go to P&L, capital item has to come to balance sheet. So for that reason, when it comes to the balance sheet perspective, so we are following capital approach, government grant will be considered as a capital item. So how do you consider government grant requirement? Government grant is utilized as reduction from cost. Reduction from cost of asset. So basically, whenever there is a grant received for the purpose of fixed asset, then whatever grant is received, if you apply capital approach, now one approach if you apply, it should be applied consistently. So if you apply capital approach, at that time you have to reduce the grant received from the asset value. So if I have to take up an example on this, say the cost of asset is actually 5 crore. Okay, grant is received to the extent of 3 crore. If this is going to happen automatically, if you follow capital approach, what should I do? Consider the value of asset directly as 2 crore. Because effectively from your pocket, how much money has gone? 2 crore. That is the value at which the asset will be recognized. That's it. So that's how you do the capital approach. So if any grant is received, deduct it from the cost of the asset, recognize the asset at the net value. As simple as that. Now, if I have to pass journal entries, under capital approach, first, for recognition sake, so what will be the first entry? It will be fixed asset account debit to bank account. Fixed asset account debit to bank account, very important, at net value. So in the previous example, value of the asset or total cost of the asset is 5 crore. Grant is 3 crore. So how much is the value at which the entry will be passed? 2 crore net value. Okay. Once you pass the entry for receipt of the grant as well as the adjustment of the grant, everything, the net effect of that entries are fixed asset account debit to bank account. Once that is done, depreciation will be levied. So it will be depreciation account debit to fixed asset account. And important thing, on what value will you apply depreciation? Again on net value itself. Apply depreciation on the net of value after deducting grant. Finally, transfer depreciation to P&L. So it will be P&L account debit to depreciation account. So this is how you pass an entry whenever you follow capital approach and at the time of recognition. Now, suppose in the future year, they did not fulfill conditions. What happens? Automatically refund will arise. If refund arises, then what are the consequences if you follow capital approach? Whenever, simple point to be remembered from the accounting perspective, whenever refund takes place, reverse it. So what did you do during recognition? Reverse it at the time of refund. Recognition, what did you do under capital approach? Deduct grant from asset. Now what you should do? Ulta, add the value to the asset. So therefore, during refund, what should I do? Add grant or add refund amount to asset. So initially when you took the grant, you deducted from the asset. Now when you refund the grant, you add it to the asset. Opposite effect. What entry will I pass for refund then? Refund entry will again be fixed asset account debit to bank account because you are paying for it. And it will be increasing the value of the asset. Add back to asset, right? So fixed account debit is adding the value to the asset. Then afterwards, depreciation entry will come. Depreciation effect is supposed to come. So depreciation account debit to fixed asset. Now the thing is, it should be done on revised fixed asset on prospective basis. So whatever revised fixed asset value you have, do it on a prospective basis. Example, so say in the previous example only, 5 crore, 3 crore, 2 crore. So you recognize the value of the asset at 2 crore. Say refund of 1 crore is done. So at that time what happened? Automatically the value of the asset now became 3 crore divided by remaining useful life of the asset. So you should do it on a prospective basis. Whatever depreciation is levied before, whatever basis was there before, that will be done till you get the refund date. Till refund date you will do it according to the previous stuff. But as soon as you refund it, value of asset increased. Value of asset increased, apply depreciation on the revised value on a prospective basis, not retrospective. Sorry, not retrospective. So that is how you need to deal with them. Okay, so this is how capital approach mechanism is supposed to work along with recognition as well as refund. Now, if at all I follow the second approach called as income approach. In income approach, what you normally do, grant will be considered as revenue item. So instead of recognizing grant as a reduction from cost, because capital item will always go to balance sheet, revenue item will always go to P&L, correct? So therefore, here what happens is government grant will go to P&L. But you have received government grant to acquire a fixed asset. Fixed asset will have its benefit over a life, over certain period of time. We call that as useful life. Fixed asset will never have a 1 year useful life. It will be more than one. Then only you call it as fixed asset. So therefore, if you treat the entire grant as income in the first year only, matching concept doesn't follow. Because you have got 10 years life for a fixed asset, you treat the income in the very first year, not possible. So what do? You defer them. So you call this as deferred grant. You transfer it to P&L, no doubt, but P&L transfer is also done based on the life of the grant. So, or life of the asset, not grant, life of the asset. So if asset is for 10 years, grant will be spread over for 10 years. Asset is for 5 years, grant spread over for 5 years. So that's how you have to deal with income approach. So in income approach, treat grant as income, but that income will be deferred according to life of the asset. Okay. Now what entries will come again? Journal entries wise. First, again I'll go with recognition. First, you will receive grant this time. So, very important point to be understood. Will you effect your fixed asset whenever you follow income approach? The answer is no. Capital approach, you deduct the value of grant from the asset, but income approach, you will not touch fixed asset at all because the income approach tells you to shift the grant to P&L. So therefore, do not touch asset over here at all for net of elements. Okay. So recognition, first it will be fixed asset account debit to bank. This time, there is nothing called as net effect. So therefore, this will be shown at total value. Then you will receive grant. It should be treated separately now because it's not taken as a net off figure. So it will be bank account debit to deferred grant account. Bank account debit to deferred grant account. Bank account debit to deferred grant. Next, after that, levy depreciation. Depreciation account debit to fixed asset. On what value will you apply depreciation? This time, total value. Because fixed asset is recognized at total value, depreciation will be levied at total value. Then shift this depreciation to P&L. So P&L account debit to depreciation. Finally, grant should be treated as income. That entry will be deferred grant account debit to P&L account. So in P&L, you will write it as by deferred grant, which means it's an income for you. So this is how you will recognize the grant under income approach. So it will be treated as revenue item, but over here it should be deferred because the benefit out of the asset runs for n number of years. Even grant will be considered as income for n number of years. So first pay off the value to get the fixed asset, then receive grant, then apply depreciation on the total value, shift it to P&L. Grant will also be recognized as income at the end of the year on a proportionate life basis. Suppose in this case, if there is a refund, you follow income approach and there is a refund. At that time, what should we do? Should we touch asset? The answer is no, because receipt of grant, you never touched asset. Reversal also, you will never touch asset. However, what should I do then? First, if there is a refund, then government grant account or deferred government grant account should be first closed. If at all there is any excess refund, transfer that amount to P&L account. So whenever you refund, deferred grant account, if it has any balance, first that should be closed by shifting and closing it off. The other amount, if it is still there, transfer it to P&L. Example, assume that refund amount is 50 lakh. You went and checked the deferred grant because grant entirely will not be closed at the beginning only. It will be spread over. So deferred grant is there. So assume that deferred grant account shows a balance of 40 lakh. Then what should we do? First write off the refund amount through deferred grant account. Close deferred grant to the extent of 40 lakh, but still 10 lakh remains. So for that, P&L comes into the picture. So P&L account 10 lakh. So that is how you have to deal with refund entry when it comes to income approach. So what is the entry we are going to pass then? The entry will be deferred grant account debit, P&L account debit to bank account. So grant will show a credit balance because the entry was bank account debit to grant when you receive it. So it shows credit balance. Now you are closing it, so debit. So therefore, deferred grant account debit, then P&L account debit to bank account. So first preference is given to this, second preference is given to this. So this is how you have to deal with the refund entry when it comes to income approach. Then what about other entries? Other entries are same. Will this affect the depreciation? The answer is no. Because you never touched asset over here, will there be any changes to depreciation? Obviously, the answer will be no. So this is how grant received income approach, if you follow, it should be covered up. The next type of grant now. So we finished off with fixed asset receipts. What about the next type of grant? If at all grant is received to meet revenue expenditure. Say for example, government will say that it will bear 1 year salary of the employees. So employees of the concern, government said, I will take care of 1 year salary. At that time, what happened? 1 year salary will be reimbursed by the government. Grant is given. So therefore, it's a revenue expenditure stuff. It's not a capital expenditure. Then how it is supposed to be considered? Now, whenever you receive grant to meet revenue expenditure, then grant has to be transferred to P&L based on benefit utilized. Obviously, the benefit will be utilized for less than 1 year only. Otherwise, it will not be called as revenue expenditure in the first place. But it should be according to benefit utilized. Okay. So basically, I received 10 crore grant. Why? To pay salary. So what should I do? Entire 10 crore shift it to P&L. Close it off. However, for example, 6 months belongs to the current year grant time. 6 months belongs to the current year. 6 months belongs to the next year. Then grant income also, half will be considered in the current year, half will be considered in the next year. But it will not go beyond this for sure, because benefit should lapse within 1 year. Then only it will be called as revenue expenditure. So therefore, whenever there is any amount received, it will be directly shifted to P&L. If it is covered under 2 accounting period, then go for a beneficial calculation. Then if at all, then I have to pass an entry for this journal entry. How to pass it then? The entry will be first bank account debit to government grant account. This is for receipt of the grant. You receive it. After that, you pay off the expenditure. So expense account debit to bank account. You pay off the expenditure. Then afterwards, what will we do? We are going to shift government grant to P&L. No. Okay, so you are going to shift government grant to P&L. There won't be any deferred calculation over here, because it's a government grant for revenue expenditure where the benefit will expire within 12 months. So this is how you have to deal with revenue expenditure government grant. If at all, this is for recognition. Okay. If at all there is a refund, then what should I do? If there is a refund, basically grant will be paid off now. So it will be government grant account debit to bank, government grant account debit to bank, and this government grant will be reversed from P&L. So P&L account debit to government grant account. In the previous year, you treated it as income. So therefore, the entry was government grant to P&L. This time, you are refunding it. It's a loss. So P&L account debit to government grant. This is how you have to deal with the second aspect, if at all grant is received for revenue purpose. The final one. If at all grant is received as promoter's contribution. Now, what do you mean by promoter's contribution grant is given up? Basically, in this particular case, what happens is government provides grant to meet the incorporation or expansion of business. So government is giving grant because you started an organization in a specified area given by the government. Example, at that time what happened? Government is not giving you to meet fixed asset. Government is not paying grant to meet revenue expenditure. Government is giving you grant to start your business or you expand your business. Do whatever you want. Grant is given. What happened? This is called as promoter's contribution. To promote, to start, if government gives you money, call that as promoter's contribution. Now, whenever promoter's contribution comes into the picture, since it is related to incorporation and expansion, it's always capital receipt. Because this is not something for which shares will be given. If shares is given, what happens? It becomes government participation in ownership. It's out of AS 12. Here, government directly assisted the enterprise by giving money and asking them to utilize to start or expand their business. So therefore, it became a capital receipt. Now, once it becomes a capital receipt, then what entry should I pass for recognition purpose? The entry I have to pass here is first receive the grant bank account debit to government grant account, and later it is government grant account debit to capital reserve account. So point to be understood is whenever grant is received for promoter's contribution, it is a capital receipt which will be shifted to capital reserve account. Will be shifted to capital reserve account. Suppose if there is a refund, then basically what we are supposed to do, government grant account debit to bank, just look into the other two entries. Don't you think that it's basically the direct opposite of what we are doing? Correct? So it is government grant account debit to bank because you are paying off. Then adjust this. How do you adjust it? Capital reserve account debit to government grant. Okay, so if promoter's contribution is received, all the amount will be shifted to capital reserve. If there is a refund of this amount obviously will be removed from capital reserve itself. So that is how you have to deal with promoter's contribution mindset. So if you could just quickly recall what we did. First, non-monetary asset, in that concessional price, calculate or record the asset at cost incurred, whatever cost is incurred. Free of cost, nominal value. Then we came to monetary asset. If it is utilized to acquire a fixed asset, then you can apply two approaches. Capital, income. In capital, what happens? Grant received is adjusted to cost of the asset. Then if there is a refund, amount is added back to cost of the asset. Suppose if you follow income approach, grant received will be considered as deferred grant, which will be deferred over the life of the asset. So that is the way in which deferment is going to happen. Suppose if there is a refund, first close deferred grant account, balance shifted to P&L. After that, if at all there is revenue expenditure, then consider the entire amount as income in this year only, or according to benefit derived, division is made between current year and next year. Afterwards, if amount is received as promoter's contribution, then make sure that you transfer the amount to capital reserve. If there is a refund, deduct the amount from the capital reserve. And very important stuff, I will just add up over here. When there is a capital reserve, do not utilize for any other purpose. You are not supposed to utilize capital reserve for any purpose. Point to be understood, whenever a grant is given, two things. One, whatever intention the government prescribes you, you have to follow that. Otherwise, grant will automatically be reversed. So therefore, you received money to start the business. Instead, you gave dividend out of it. Not possible. It should be utilized for the purpose for which the grant is given to you. Therefore, accordingly, you have to consider. So if refund takes place, then close it off. So do not utilize for any purpose basically means shouldn't use for bonus, or bonus to some extent yes, but otherwise also we exclude it. Shouldn't be used for dividend obviously, shouldn't be used for any other write-offs. Okay, it should be utilized for the purpose for which the grant is given. Once the grant term is over, then you can start utilizing the way you want. Till there is a grant term, don't use it for other purpose. Okay, so with that, come to the end of theory of AS12. So AS12 theory coverage is simple. Mainly it revolves around journal entries. So therefore in those places only I gave you the journal entries. Hope everybody understood the entries perspective. If you did not, you can ask me. Otherwise, just look into the entries once. Automatically you'll start getting the idea. So now let's start taking up some questions based on this particular standard. So let's take up the problem now. First one, this is taken from RTP. How would you treat the following in the accounts in accordance with AS 12 government grants? Rupees 35 lakh received from the local authority for providing medical facilities to the employees. Okay, 35 lakh received from local authority for providing medical facilities. First, check whether it is a non-monetary grant or a monetary grant. This is a monetary grant because amount has been received 35 lakh. If it's monetary grant, it will come in either of the three. What are they? One, fixed asset. Two, revenue expenditure. Third, promoter's contribution. Now, does this medical facility leads to fixed asset? No. Does this relate to start of any venture? No. Then basically this is revenue expenditure. If it is revenue expenditure, what have we learnt about the grant? We learned that the amount should be directly transferred to P&L. So if you transfer it to P&L and if you follow schedule 3 and all, where will you show this? Schedule 3 has only two heads. One is revenue from operation, one is other income. This will be shown under other income. So that is the way in which my answer is supposed to come up. So if you now look into the answer, 35 lakh received from local authority for providing medical facility is a grant received in the nature of revenue grant, which we discuss now. Such grants are generally presented as credit in P&L statement, either separately or under general heading as other income. Alternatively, it could be deducted from the related expense. So related expense also, there is an alternative that you can be deducting it, but you can directly write that it will be credited to P&L. That is more than enough. Next, 100 lakh is received as subsidy from central government for setting up a unit in notified backward area. So to set up a unit, central government gave you 100 lakh subsidy. Now what happened? Does this lead to a specific fixed asset? No. Does this lead to specific revenue expenditure? No. Does this lead to start or expand your business? Yes. To set up a unit, they gave you subsidy. So what happened? This is a promoter's contribution. If it is promoter's contribution, what have we learnt? We have learnt that whenever there is promoter's contribution, the amount should be transferred to capital reserve. You are not supposed to utilize that amount for any purpose. It should be stagnant as capital reserve. So that has to be elaborated over here. The government grant are in the nature of promoter's contribution. They are with reference to total investment in an undertaking or by way of contribution towards capital outlay. And no repayment is ordinarily expected whenever the payment is given. So that amount should be treated as capital reserve, neither distributed as dividend nor considered as deferred income. So you can't give dividend, you can't treat it as income. So that then they applied it in the given case and they mentioned that credit should be given to capital reserve. So that's how your case study is supposed to be approached. So monetary, non-monetary. If it's monetary, 3 types. Non-monetary, 2 types. Accordingly, you have to decide individual rules and regulations of that particular stage. Okay, this is how one question has to be done. The next question. On 1/4/2017, XYZ Limited received government grant of 100 lakh for an acquisition of new machinery costing 500 lakh. The grant was received and credited to cost of assets. The lifespan of the machinery is 5 years. The machinery is depreciated at 20% WDV. The company had to refund the entire grant on 2nd April 2020 due to non-fulfillment of certain condition which was imposed by the government at the time of approval. How do you deal with the refund of grant to the government in the books of XYZ? So what is happening here? First, monetary grant is considered because 100 lakh amount is given. If it's monetary grant, 3 purpose: fixed asset, revenue expenditure, promoter's contribution. Here, new machinery, which means this is related to fixed asset. Okay, now if at all it is fixed asset, there are 2 approaches if you remember. One is capital approach, now another one is income approach. Here what approach has been followed? They are credited to the cost of the asset. Asset shows debit balance. If you have credited to the asset, what does that mean? Asset reduced. In which approach do you reduce the value of the asset? It will be done under capital approach. So the question has followed capital approach. So depreciation is levied on the net amount, that is number 1. Asset is disclosed or asset is recorded in the net amount, and whenever refund of grant takes place, you should add back the grant amount refunded to the value of the asset itself. Depreciation is applied on a prospective basis. That is the whole idea. So asset shown at net value, depreciation applied on net value, refund is added back to asset, depreciation after refund will be done on a prospective basis. Now accordingly, if you go into this particular question, asset has to be now recognized at 500 minus 100, because total is 500 minus grant 100, so it will be valued at 400. That is number one. After that, 20% WDV is applicable on this 400 lakh. So keep on applying them. Why? Till what date it should be done? 2020 2nd April is the date of refund, which means 17 is the purchase date. So 17-18 1 year elapsed, 18-19 second year, 19-20. So I should apply for 3-year depreciation, because after third year refund is taking place. Once the refund takes place, it will be done on a prospective basis. So therefore it has been done. See, 1st April 400, then 20% WDV. So this will give me book value as on 18-19. Then again 20% WDV, book value as on 19-20. And for that, you have to apply depreciation again. So as on 1st April 2020, the balance is 204.8. After that, what should I do? Add back the grant. So the revised value became 304.8. So on this 304.8, on a prospective basis, depreciation will be levied. Now look into the sentence given. Depreciation at 20% on the revised book value amounting to 304.8 lakh is to be provided prospectively over the useful life of the asset. So that is how you have to do it. So first deduct all the depreciation till the date of refund. Then add back the amount of refund. On this total amount, apply depreciation on the remaining prospective basis. So that is how the whole thing should be done. So each situation when you deal with, when it comes to AS12, you have to see what grant it is and associated conditions on the grant. If this was taken under income approach, will this affect depreciation in any way? No, because in income approach you don't touch the asset at all. You touch the deferred grant account. So each situation will have its own way, and that you have to take up one by one. Okay, so with that we come to the end of AS12 discussion. Now we have to move towards the discussion on AS6. Before we move on, the highlight points in connection to AS12. So first, the government grant recognition, then second, types of grant, then accounting. Now accounting will be for two things. One, for recognition, second, for refund. Now which are the elements covered for that? The elements covered for that are non-monetary grant, which is bifurcated into concessional price and free of cost, then monetary grant, which is bifurcated into fixed asset, revenue expenditure, and promoters contribute. These are the ways in which your elements of AS12 is supposed to function, which you have to look into it and try to understand. So with that, AS12 is officially done. Last accounting standard discontinuing operation. Okay. Very rarely questions has been asked from this standard in the exam for the time being. Only once maybe it has been asked, but apart from that, they don't target this standard much. But nonetheless, we are not supposed to leave any of them. We are supposed to learn everything so that even if they ask a surprise note, we are ready for it. Now, in this particular standard, what you are mainly going to learn is whenever there is a discontinuing operation, how disclosure is supposed to take place. Okay. So in case of these discontinuing operations, how disclosure can happen. Now, another thing what you need to understand here is this is discontinuing operation. Okay. It is going to get discontinued. So you are doing an operation whereby there are different set of operations you have, and in that one of them is getting discontinued, and it is not discontinued already. So those, if at all it is getting discontinued, then users of the financial statement should know the finance effect of this discontinuing operation. So therefore this element comes into the picture. Now if you remember schedule 3 format of Companies Act, it tells profit before tax, then it tells tax effect, then it tells profit after tax, then it mentions about from continuing operation, and then it mentions discontinuing, and afterwards it tells total profits or profit for the year. So what is happening here then, if at all any operation is getting discontinued in future, automatically it comes and sits over here, and only continuing operation has to be written over here. Reason, next year onwards this operation is not there. So any profit is earned is done with this. Your decision will only lie with continuing operation. If you merge the two and show it, the users cannot make a proper decision about this. So therefore, to show that there is continuing operation, what is the potential, discontinued, how it has thrown out, that has to be shown in financial state. For that reason, this standard comes into the picture. The first thing what you have to learn in this particular standard is, what do you mean by discontinuing operation? So what are supposed to be considered when it comes to a discontinuing operation? First, based on a plan, okay, based on a plan, you are going to, number one, sell off entirely. Number two, piecemeal sales, or abandonment of what? Of segments, of segments which has got its own distinguishment. This is called as a discontinuing operation. So what is happening? According to a plan, either you are going to sell off the entire part. Okay, let's assume that you have got say a paper business and chocolate business. Let's assume like this. Okay, you have got a paper business and a chocolate business. Now, based on a plan, you are entirely selling off chocolate business. So what happened? If you sell the entire chocolate business, then it is selling off entirely. Or else you are going to make a piecemeal sales. So whatever factories you had of chocolate business, you are selling them one by one to different people, but you are closing that off. That is another one. Third, you are abandoning chocolate business. You are stopping it off, and you are not entering into chocolate business again. It's done. You are abandoning, you are terminating that, and it's over. So that will be called as abandonment. Okay, so in selling off entirely, what happens? There will be a binding sale agreement, which means that particular selling agreement has already been entered into will be executed in future. It is binding. You are selling it, they are buying it. Okay. Then piecemeal sales, if it is happening, it could be done to anybody. So if major of them are getting sold, it could be done to anybody. Then abandonment means you are terminating it, you are stopping it, and you are not starting that again. So this is how discontinuing operation has to come. What is supposed to be sold? What is supposed to be abandoned? One segment. Segment can be either business segment or geographic segment. This will be discussed in detail when we take up AS 17, but segment is basically one part of the business which has got its own element. So those things, either it depends upon business or it depends upon place. So business is called as business segment, place is called as geographic segment. So it has to be a segment. So chocolate and paper are two different types of businesses. So therefore chocolate will become one segment and it is getting abandoned. So that is how this thing should be understood, and it should have its own distinguishment. So chocolate has its own distinguishment. So that is how discontinuing operation comes into the effect. Okay. Now, when it comes to abandonment, not everything will be considered as abandonment just like that. So there are some things which even though comes under as exceptions to abandonment. To some extent it is important. There are certain exceptions to abandonment. Now, what are they? Number one, evolutionary phase out. Evolutionary phase out. Now, this means that according to market, you shift the way you are going to sell your product or produce your product. That will be called as evolutionary phase out. If evolutionary phasing out you are doing, that is just to acquire the market. This will not be called as abandonment. So this doesn't come under abandonment. What about the second one? The second one talks about business is alive, only product is discontinued. Business is alive, only product is discontinued. Example, chocolate business is there and there are 5 toffees which was produced in this particular chocolate business. Of this 5, you stopped 2 of them. Business is there. 2 of the chocolate products are stopped. This is not closure. This is not discontinuing. Business is there, right? If business is there, then that is continuing business. You stop certain products, you start certain products is totally left to your market requirement. So therefore, this will not be called as abandonment. Then the next one, another one which is taking up over there is shifting of factories or production lines, anything. Now, if you shift from one place to the other, say geographic segment point of view, it is depending upon the place. So if you are shifting the place from one place to the other for the market requirements, now that will not be called as abandonment. You are still there, but you are just shifting from one place to the other. This is also not considered. And the final one, temporary stoppage will not be considered as abandonment. You are stopping it now because you felt that there is no demand. You are stopping it now. After 1 year, you want to continue it again. This is not abandonment. So if you are gradually phasing out for market purposes, no. Second, if business is alive but only product is getting discontinued, no. Third, if you are shifting from one place to the other for market requirements, no. Fourth, if you are temporarily stopping it, it is not considered as abandonment. So these are exceptions to the term abandonment. Now once that is done, the next part is, say now discontinuing operation is confirmed. It will be discontinued on a future date. It is discontinuing now. If that is the case, initial thing what comes is called as initial disclosure event. So now your users should know what is happening. Now your users should know what is going to happen when it comes to discontinuing operation, that is called as initial disclosure event, which means from when you need to start disclosure. So from initial disclosure event, you need to start your disclosure. Now, how it is supposed to be done? It is two dates have been given. So one, date of binding agreement, or date of formal plan and announcement. Whichever is earlier. So from when you need to start your disclosure, either you enter into a binding sale agreement, that is one, or you have a formal plan and you make an announcement of it, whichever is earlier. So binding sale agreement entered date is 15th of February. Announcement date is 15th of March, whichever is earlier, 15th Feb. From then your disclosure should start. Okay, that will be called as initial disclosure event. Now, what type of disclosure are we supposed to do? Description. So you need to give the description of what type of discontinuing is going to happen. Second one, you need to tell about the segments which are going to get affected on this particular thing. What type of segment is getting discontinued? Third one, you have to tell about initial disclosure event. You have to tell about initial disclosure event, how that initial or when is the initial disclosure event came into the picture. Fourth, when this is going to get completed, when your discontinuing operation is going to get completed. Number 5, carrying amount of all your discontinuing operation related assets and liabilities. So carrying amount has to be mentioned. 6, pre-tax profits are supposed to be mentioned related to discontinuing operation. 7, tax effect on these discontinuing operation should be given. Last, you have to tell about the post-tax profits. So these are the disclosures which we come across, which we need to tell. So description of the element of discontinuing operation. Second, the segments involved. Third, when the initial disclosure event came into the picture. 4, when are you going to complete your operation or discontinuing, when it is going to be totally discontinued, what is that completion date? 5th, the carrying amount of the assets. 6, pre-tax profit. 7, tax effect. The last one, post-tax profit. So this is the disclosure which is needed when AS24 comes into the picture. Later we start telling them that you need to update these disclosures. Any changes is going to happen, you have to update them, tell them how it is supposed to be done. Until and unless your entire business or that discontinuance gets totally completed, then you have to stop disclosure. Till then it should go on. So the important thing about this standard is it is discontinuing. It is an ongoing process. It is not completed yet. It is discontinuing. As soon as it is getting discontinued, you need to disclose it. These are the disclosure requirement. Once it is over, once it is completed, stop disclosing that particular element. So this is how it should be done. The important one is the definition over here. What is that discontinuing operation? So there has to be a plan. According to the plan, there has to be a total sales or piecemeal or abandonment. Then what is supposed to be considered in the plan? One segment, either geographic or business, and it should be distinguishable. It has a different element altogether. Then some things are not abandonment. Then what is initial disclosure event, whereby earlier of date of agreement or date of announcement, whichever is earlier. Finally, what are the disclosures we need to do? So this is about how AS24 comes into the picture. Questions in the exam are very rarely asked, but RTP there is one question which I have picked up. I'll quickly discuss that part. What are the disclosures and presentation requirement of AS24 for discontinuing operation? The one which we discuss now. Just see description, segment, then initial disclosure event, when it is going to get completed, carrying amount, pre-tax profit. Okay, then they have also added revenue and expenses, then tax effect and post-tax profits. So those are covered in disclosures. Then check the next. Give 4 examples of activities that do not necessarily satisfy criterion A of paragraph 3 of AS 24, but that might do so in combination with other circumstances. Now, this particular thing is that non-abandonment situation, which I told you that if you make a phase out, it is not considered. Second, if at all several products are there but business is alive, it is not considered. Third, shifting from one place to the other. Fourth, closing facility for a temporary basis. These things are not considered as discontinuing because they are not abandonment as such. So this is how the questions are asked. So whatever you have done, straightforward questions are normally asked in the exam. So these things, try to remember them. So that is why here you have got sentences. In the previous thing which I have showed you, I gave you in words only. So that one word you can remember them and you can produce that as a sentence in the exam. So this is how AS24 comes into the picture. First 3 are important because they have asked most of the times. This is not asked that many AS24, but yes, sometimes they may ask it in the exam, but be ready with it. So this is how it is supposed to be done. So whatever is covered here is enough for you to remember what AS24